Welcome to the fourth quarter review for the commercial portfolio at Greenleaf. Today, we're going to cover everything that's happening really in the commercial space, how our assets are performing, and give an overview of what opportunities that we see in the space. Most of the time when you think of commercial space, your mind kind of goes right to multi-story office. It's a lot of where like kind of the buzz discussions are happening and you're like, yes, there's big challenges there. However, it's not really that clear. A lot of the Class A, big, nice buildings, a lot of them are performing well. In the Atlanta and the Southeast markets, we're seeing rental rate increases. We're seeing net absorption. We're seeing lots of people that are back to work. So we think that kind of the bottom of the market was probably about 2 years ago from purely an occupancy standpoint, and it has been growing each quarter since then. So we're seeing strong demand in just leasing office space. Now, there's also some things that are not working very well in the office thing. It's an older building. If there's no TI dollars available to spend and get that space fixed up for a new tenant, if it lacks amenities or has bad ingress for driving in there and stuff, those spaces are really struggling. So there's definitely a lot of vacancy and issues with those types of assets, but a lot of the vacancies really pushed into some specific underperforming buildings, while a lot of the assets overall are performing very well. We think probably the occupancy decline bottom was probably about 2 years ago, and everything that we have been seeing in our numbers and everything has really been trending up since then. So when I talk about commercial at Greenleaf, we always have a little bit of a different slant on what does that actually mean for us. So our commercial portfolio is about 1.5 million square feet of space, and it's really compressed into three segments. The first one is our medical space. We have about 300,000 square feet of medical office buildings, or MOB, and overall it's 95% occupied. A lot of our tenants there, we have LabCorp. It's a very big tenant. We have multiple locations with them. We have surgery centers or imaging centers. We have eye care centers. We have dental groups and primary care physicians. So that's a lot of the space use that we have. Those typical tenants are anywhere from 3,000 to 10,000 square feet amount of space that they're taking up. And again, we're 95% occupied there. Things have been working very well on the medical side of our portfolio. And although we haven't bought anything recently, asset prices there have continued to rise. Another segment we have is our government segment. And that's a little looser defined. We look at a building, if we have a couple government tenants there, we're like, okay, this one is mostly government. We'll push it into that category. We have 450,000 square feet of government space, and it's 75% occupied. That vacancy really occurs in two main buildings. We have a building up at our Midtown complex in Chattanooga that we have the city of Chattanooga. They're a larger tenant that take up almost 30,000 square feet. But we have some vacancy in that building, and it would be great to lease that vacancy, another 25,000 square feet, to another government or state or local agency. So it's kind of a cohesive tenant mix. That's why we call that government. We also had a North Carolina insurance department that was a state user that we had up in North Carolina. They vacated. That building was technically government, so we left it in our government pool, and it went vacant, but we're already leasing that one back, and it's trending more towards medical now. So they kind of ebb and flow out of asset classes, but overall, government, 450,000 square feet and 75% occupied. Our next biggest chunk is really office. And most of our office is 1 or 2 story. We don't really have any super tall office buildings. Most of it is 1 or 2 story, more suburban office complexes. We have a lot of walk-up entrances. About half of our space is exterior walk-in office. And that's something we learned from the multifamily space of saying, hey, we want to have exterior entrances so everyone has their own suite. They're not going through a common area. That's about half of our portfolio, but of the 750,000 square feet, we're 85% occupied in office. And in the Southeast, that's right in line with what the market is showing. Obviously, we want to be better than the market. We're always trying to win. We want to be 100% occupied as much as we can. Our tenants there, we have a lot of stuff that's logistics related, and these are transportation logistics, especially in Tennessee. That's our biggest users that are up there. We also have a mix of education place. We have assemblies. We have church groups. We have a lot of professional services, which come in the form of attorneys, architects. Those are two of our biggest professional service users. And then we have general contractors and construction services as well. Those are the typical users that we have in our office space. And most of our office stuff is smaller. Greenleaf in general, we have some big tenants, but really our bread and butter is kind of that 5,000 square foot suite. That's where we focus a lot of our leasing effort. So that ties me to leasing, and we're going to talk a little bit about deals that they kind of ebb and flow in what category they fit in our portfolio. I'm going to start with Lakeside. Lakeside is a deal that we own. It's in Tucker, Georgia, and we purchased it, and we're like, look, this is a great single-story office, and we're going to convert it to flex. It's going to jump to our flex portfolio. That was the business plan the whole way, and it's multiple buildings. So we have some buildings where we took the vacant space and we converted it to flex, and we've leased those spaces, and that's been working out well. However, we've also had users come to us and really focused on the medical space that wanted to be there. So they built out medical space in our flex space. So it's a little bit of a mixed deal where some buildings have more medical and one building is more flex oriented. Right now, we're lumping that in because we have Tucker, which is we have a city hall for one of the local municipalities here in Georgia. They're kind of like the main tenant that's there. So like, okay, this falls in our government pool, but it's really a deal where it's leasing to all fronts. It's leasing to government, medical, and flex all in one complex. So leasing there has been very strong. We've gotten that deal up to 92% occupancy. It was performing very well. We did receive notice that one of our larger tenants, that is a nonprofit, plans to downsize now and then probably also vacate in a 3-year period, which is okay. I obviously wasn't planned, but we have a strategy to tackle that. We're already going back in, and Autism Centers has really been one of our big groups that are leasing space. They're looking at taking a big chunk of that space that they'll be vacating, and they can really repurpose the rooms and the stuff that are there. So that would be one where it doesn't necessarily get demoed to flex. It might just stay as the same type of user and have same type of space, but have a different kind of user that goes into it. So we're working through that one right now. Some other leasing highlights, the building we have up in Charlotte, it's called North Graham. That one we only have one suite left. Now, we've had one suite for most of the fourth quarter. We've leased that up. It was office. We leased it to a construction services group. There's a cabinetry group in there. There's a photography studio in there. So we have leasing momentum. We just have one more suite left that we want to do. Another one, when we talk about leasing, is our Park Lane deal. This is a medical deal. It's a medical strip center, so it's single story. We have orthopedics groups in there, pharmacy groups, dental groups, eye care groups, and that one has been really holding at 100% occupancy since we bought it now. So it's had a few years where it's performed well, continues to make distributions, and we're seeing consistent 3 to 4% rental rate increases there. We just signed a new lease there. We're in our 3rd year of ownership there, and we're right on track with our pro forma rents that we're hitting. 3 years ago we bought it, we thought we were going to be around $18.92 as our blended rental rate. We just signed a most recent lease at just over $19 a square foot, so it's performing well, and we're very excited about how the medical stuff is working. On the next one I want to touch base with is Crossing Centers. We bounce around through some of the deals. We're really trying to look for like what trends and opportunities do we see in them. Crossing Center is a deal that is exterior entrance and exterior walk-up. We have other deals like that, one being Johnson Square, also very close by to that, and another one being the station. So these are over 300,000 square feet of our office space. They're all three of those deals, Crossing Center, Johnson Square, and the station, are all similar layouts. They're all 3,000 to 7,000 square foot suites. We have numerous tenants in each of those complexes, but we continue to see strong rental demand at each one of them. Across the board at Johnson, we are in the high 90s. At Crossings, we're in the high 80s. And at the station, we're in the mid 80s% occupancy. We always have opportunities to go lease and turn stuff there just because there's so many tenants. And right now, we're also seeing that same consistent 3 to 4% rental rate gains each year. We're also seeing these buildings, as we convert them to have CAM reimbursements along with the lease, that's a big way that we even out the expenses. It also helps us get the tenants on board with being conservative in our cost usage, especially on the utility front. So that's helping. And we're doing that with almost all of the leases that we have there. So next I want to talk about is we bought a deal, and the whole plan was to go fully flex. This is our hub flex deal that's up in Milton. Well, fourth quarter comes along, and FEMA wants to take 30,000 square feet. So we signed a lease really quickly with them. They moved in within a week, and they took an existing space that was there. It was built out as office. It was in a building we were planning to renovate about a year from now as we get through the permitting design phase. So they're going to take that space for the time being. So on that deal, it's a flex deal. However, we have a government office user, commercial user that's in there for a time being. And it's a great tenant for that space for right now. It fills that gap that was there. So we're super excited about how that deal has turned out, adding that government office component to something that, even though that wasn't the plan, it was able to work really well. We look at some of the medical stuff and how that is performing, and touch base on Park Lane and how positive that deal has been going. We have another deal in Anderson, South Carolina. It's called Palmetto. It is 4 medical suites, and we've essentially turned over that entire building. Typically, we go into a deal and we are aiming to retain our customers, retain our tenants there. Just like we do in any of our assets, we want to see higher retention. It makes for a more stable deal. At this deal, we had low retention. We had doctors that retired. We had doctors that decided to move out. So as it moved out, we had to move new tenants in. We signed groups like Quest Diagnosis. They're one of the new tenants. We have other medical groups that we have moved in there. So we're fully occupied. And now because of that, we did that big heavy lift and that big turn. Most of our leases go out until 2029 on that deal. And we have one more suite that has a sublease in it that ends in August of 2025. So we're going to try and work through that lease, and then we're going to try and see if we can market this deal, take it out. It's going to have the longest weighted average lease term that we will have, meaning the average lease that we have of the building will be as long as possible. That's the optimal time to realize value in the sales cycle. So we will take that out and see if we can realize those gains here really in the spring. That's our timeline there. Another one we have is Parsons Meadow. This is a medical deal that we purchased that was stable, and we had 2 doctor's offices that moved out. So now we have suites there that are available. However, it's in a medical complex. So there's lots of different medical users that are there. And we want to make sure that we add a medical tenant to it. We do not want to be in a situation where we're adding in kind of unrelated users to the space. It's better for the complex as a whole. It's better for our asset. It's better for the advertising there. It all makes it better. We had one of the groups that left was a HR service provider that was there. Okay, we need to get back and put in another medical tenant to take that space. So that's what we're working on there with that. So I want to touch base now just on some of like the decision making and how we look at solving some of our problems as they come up. Or really, if we can go buy some problems, figure out what playbook items can we use to tackle this stuff. One deal I want to talk about is the Sumner deal that's up in North Carolina. This is one where we bought it was originally the NC Insurance Rate Bureau that was there, North Carolina Insurance Rate Bureau. It had 28,000 square feet. This is a building built specifically for them. We bought it knowing it had a shorter term lease. And our whole goal was we'd be able to offer a renewal package, keep them in place. The groups we talked to during due diligence indicated that they most likely wanted to stay in the space. However, roles turn, things happen, people take businesses in a different direction. So there's a new, I would say, lead of that organization that came in, and she decided she wanted to move their headquarters to another location. And therefore, the Rate Bureau just recently vacated the space back in August of 24. At that point, we have to move pretty quickly. We need to come up with what is our game plan to proceed. A lot of times when we do that, we work with our brokers in the local area to figure out what is the best use of this building. We were going from a government single tenant use, and we now have to morph and change our game plan. We have to do it quickly. In order for that to be successful, we decided to take this building, it's a 2-story building, and divide it into 4 suites. So we now have 4 suites that are roughly 7,000 square feet each that we have mapped out and organized in the floor plan. To do that, we had to move the bathrooms around a little bit. So we had to spend some TI dollars to get these suites looking correct. The first thing we did was we leased one to an autism center. They're moving into that space. They're doing their build out on it, and they will replace about half of the rent that we lost. So the new rents are much higher, which is great. However, we're going through a turnover there that we had not planned on. So our game plan here went from just work on the renewal, work on a TI package, to let's divide up this space. Let's get new tenants in there. Let's build our weighted average lease as much as we can from the new tenants and see if we can get them around medical or education-based users that are there. That consolidates who the tenant type is. And then we would look to either say, hey, should we exit this deal and realize the value, or should we continue operating this? During that transition, since we did not plan, we planned to have 100% occupancy the whole time. Plan to be able to issue a TI package and keep our revenues coming. When we see those revenues drop, our revenues will be down for almost a full year on this asset because that really impacts our ability to make distributions, but we can still execute the business plan. So on that deal, we're not going to have distributions until we get it fully leased up and back in operating condition. Another one I want to touch base on is our Lupton deal that's up in Chattanooga. We have 5 tenants now. So as we stabilize that deal, as we finish the construction, we now have 5 tenants that are in that space. It is office. So we are leasing office space. The interior of it looks really cool. The basis doesn't look cool from how long it was unoccupied and we were not getting rental revenue. But now we have some momentum. We have tenants moving in. It shows really well. And we're confident we're going to see continued occupancy gains really throughout 2025, a little bit per quarter as we get that thing fully occupied. Our goal is to get that done in 2025. On the acquisition front, a lot of times in the commercial space, we've got these 3 segments. We've got our pure office, we have our medical, we have what we look at as our government space. Opportunities come up that we like when there is a turnover event, when there is a long-term tenant that has moved out, not necessarily a short-term tenant. A longer-term tenant typically hasn't had as much TI done. Maybe it's not as nice, and there's a way we can go in and do some work and really add some value and get a new user in there. So we look for these problem events to happen, and that's really where we see opportunity to go buy something. A lot of time what's happened right now is on the acquisition side, we can find the single-story office that's out there. There's just not that much of it, and the price points are still relatively high. There's not just fire sales where people are like, hey, we got to dump this asset. That is not the case. So things are still there and they're maintaining their value, even if they are vacant. We looked at a recent office complex where it was around $140 a square foot for a single-story office, and it was only 30% occupied. One would think that thing should be trading for a lot cheaper, but that is not the case right now. And so the prices are still pretty high. So it's a little bit tricky to go find opportunities to buy these specific assets. We have not bought anything in the medical front for almost 2 years. Prices there have just continued to rise. We get offers on all of our medical stuff pretty frequently. So it's still a very attractive asset. We don't see a great opportunity right now to buy more of it just because it's too expensive. On the government side, very similar trend. I think there's some just general concern of what's going to happen on the government lease side, but it sounds like they're going to say, hey, all government work is back in the office full time. It's kind of what we're thinking there. But also prices on government assets have held very strong because they're pretty good credit. They're normally paying their bills. So it's stable rental revenue that's coming in. We haven't bought any government deals recently, although we did do that FEMA lease. So we leased to a government tenant. We've leased other government space. We have not bought any government space recently. We're always looking to see if we can find it. It's priced a little bit better. There's a little bit more opportunity than buying just the pure office because you have better value with the tenants paying there. We just have not seen much come up for sale. The other part is the just pure office. And there is a lot of office that's out on the market and is available. And for us, it's just really finding that unique one that actually works, is one that we can come into and put the right value in and turn that thing around. So Most of what we've focused on right now is purely single-story office, and that falls into converting it to flex. That was in our industrial video that we talked about. So we've done a good chunk of that. Our 3 last deals have all been this single-story office that we're converting to flex. So it doesn't fall into this presentation, but that's where we really see a good amount of opportunity is those single-story office. Now, there's also opportunity to buy just single-story office that needs some love and it needs some TI dollars, and we can lease it as office. We're also very much looking at those opportunities because we think we can get some great price points there. We don't have any immediately, but that's where we're opportunistic to be able to see something. Hope this was helpful. Touching base on the commercial footprint at Greenleaf. Again, we have 1.5 million square feet. It's broken down to those 3 categories of medical, office, and government. That's really where we focus on our operation, and our opportunity sourcing is right in those 3 pockets. Please let me know if you have any questions. All of the investor information goes out on the 20th, like it does every quarter. Distributions and distribution notices, all on the 20th as well. And all of those good year-end tax forms, those will also be loaded into your investor portals really towards the end of February. Thanks for watching, everyone.